Investing in financial markets can be both thrilling and intimidating. For those who are just beginning, the journey is frequently characterized by obstacles and traps that can either ensure or undermine their investment success. Despite the abundance of information on the multitude of strategies that experts have proposed, novice investors often make critical errors that can impede their financial objectives. Despite the abundance of information and the multitude of strategies that experts have proposed, novice investors often make critical errors that can impede their financial objectives, despite the bounty of information available. In this video, we will explore 5 of the most prevalent errors that novice investors make, and more importantly, how to avoid them. Whether you are a novice investor or seeking to enhance your strategy, comprehending these errors will enable you to develop a more informed and resilient investment strategy. We will investigate how to circumvent these traps and establish a foundation for long-term success in the realm of investing. In this video, we will explore 5 most common mistakes that novice investors make and how to avoid them. Number 5, failure to comprehend the investment. Warren Buffett, one of the most renowned investors of all time, firmly discourages investment in companies with business models that are not entirely comprehended. His philosophy is centered on the notion that the business model of an investment must be transparent to make informed decisions and effectively manage risk. The probability of encountering unforeseen issues and misestimating the true value of your investment is increased when you invest in complex or opaque businesses. Buffett recommends the establishment of a diversified portfolio, which is typically achieved through mutual funds or exchange-traded funds, ETFs, to reduce this risk. This investment vehicle provides exposure to a diverse array of assets, thereby mitigating the effects of a single underperforming investment. Buffett underscores the significance of possessing a profound comprehension for those who opt to invest in individual equities. Before investing capital, investors should conduct a comprehensive investigation and gain a comprehensive understanding of the financial health, competitive advantage, and market position of each company. This well-informed approach guarantees that investments are consistent with your financial objectives and risk tolerance. Moreover, Buffett's counsel underscores the importance of investing within one's circle of competence, which entails concentrating on industries and companies that one is acquainted with and can evaluate effectively. This principle is an effective safeguard against investing in fields in which one is unfamiliar and may be deceived by superficial or misleading information. By concentrating on sectors in which you possess a high level of expertise or a deep comprehension, you more effectively evaluate risks and opportunities, thereby increasing the likelihood of achieving favorable returns and making more informed decisions. In addition to identifying prospective investments, this disciplined approach also assists in avoiding potential pitfalls that results from a misunderstanding of complex business models. Number 4, developing a romantic attachment to an organization. It's simple to develop an emotional attachment and lose sight of the original purpose of an investment when we observe a company we have invested in performing well. This occurs all too frequently. Rational analysis and the potential for financial gain should be the primary factors driving the initial decision to purchase a stock, rather than emotional attachment to the company's success. It's imperative to preserve a disciplined approach and refrain from allowing sentiment to influence one's decision-making as the investment advances. Continuously assessing the fundamentals that initially justified the acquisition is the foundation of a successful investment strategy. This entails conducting consistent assessments of the organization's financial stability, market position, and growth prospects. It may be necessary to reevaluate the value of holding the stock if there are substantial changes in these fundamentals, such as increased competition, declining revenues, or management issues. Holding onto a stock solely based on past performance and disregarding these changes can result in suboptimal results. Furthermore, the ability to make informed decisions regarding the sale or retention of an investment is facilitated by the maintenance of an objective perspective. A structured approach to portfolio management can be achieved by establishing predefined criteria for selling, such as target price levels, or changes in fundamental metrics. By adhering to these criteria and avoiding emotional bias, you can make more prudent investment decisions that are consistent with your long-term financial objectives. Number 3, inability to maintain patience. Over the long term, a methodical and gradual approach to portfolio expansion is frequently more advantageous than the pursuit of rapid, substantial returns. Investors are more likely to weather market fluctuations and capitalize on the compounding effect of constant returns by emphasizing consistent, incremental gains rather than anticipating rapid wealth accumulation. This disciplined approach is consistent with the fundamental principle that sustained gradual growth is more dependable and less hazardous than the speculative or high-stake investments. It's imperative to maintain realistic expectations to achieve success in the investment industry. Disregarding these expectations can result in disappointment and potentially detrimental decisions, as portfolios are intended to achieve specific financial objectives within a specified time frame. Investors can maintain their commitment to their long-term strategy by acknowledging that substantial returns typically necessitate perseverance and time. This understanding reduces the likelihood of making impulsive changes based on the short-term market fluctuations. Investors can more effectively navigate the market volatility and achieve their financial objectives over time by adopting a patient and methodical approach. Number 2, attempting to time the market. Attempting to predict the market is a strategy that's often fraught with difficulty and results in suboptimal returns. Even for experienced investors and large institutional funds, accurately forecasting the market highs and lows is notoriously difficult. The inherent unpredictability of markets means that attempting to time investments can lead to lost opportunities and lower overall returns. Gary P. Brinson L., Randolph Hood, and Gilbert L. B. Bauer's seminal research, Determinants of Portfolio Performance, published in 1986, underscores this challenge. The research revealed that investment policy decisions, specifically asset allocation, could account for nearly 94% of the variation in portfolio returns, as opposed to the market timing or individual security selection. In simpler terms, the research underscores that the long-term performance of a portfolio is primarily influenced by the allocation of assets among various categories, rather than by the endeavor to predict the market movements. This emphasizes the significance of a strategic asset allocation-focused investment strategy, as opposed to attempting to capitalize on short-term market fluctuations. Number 1, allowing your emotions to determine your behavior. Emotions, such as trade and greed, can be detrimental to long-term success when it comes to investing. The axiom, fear and greed rule the market, emphasizes the reality that these emotions frequently induce investors to make impulsive decisions. For example, investors may exit their positions at inappropriate times during market downturns due to panic selling, which is promoted by trade. In contrast, their risk exposure may be elevated as a result of their inclination to pursue speculative gains, which is fueled by avarice. Both scenarios have the potential to undermine investment returns and diverge from a well-planned strategy. Historical data illustrates that market returns can be highly volatile in the short term, but those who maintain patience typically experience superior long-term performance. Investors who maintain their composure, even during periods of negative returns, frequently achieve superior results than those who react emotionally. This is because the stock market has historically demonstrated an upward trend over protracted periods. This fortitude enables investors to capitalize on the market's overall expansion rather than being influenced by transient fluctuations. It's not uncommon for novice investors to become entangled in the emotional response to market fluctuations. A prevalent error is the impulsive investment of short-term trends or frantic sales during downturns. It's essential to establish a long-term investment strategy and adhere to it, rather than allowing emotions to influence decisions to circumvent these traps. Investors can more effectively navigate market volatility and potentially benefit from the irrational behavior of others by maintaining patience and focusing on the larger picture. Investing can be a difficult landscape to navigate, particularly for novices. It's essential to comprehend and prevent common errors to develop a successful investment strategy. By acknowledging the potential hazards of not having a comprehensive comprehension of your investments, allowing emotions to influence decisions, and attempting to time the market, you can significantly increase your likelihood of achieving long-term financial success. Warren Buffett emphasizes the significance of maintaining a disciplined approach and investing within one's scope of competence, emphasizing that knowledge and patience are the most effective allies. A steady, informed strategy and avoiding the pitfall of emotional investment can assist you in navigating the market fluctuations and achieving your financial objectives. If you found this story eye-opening, don't forget to like, share, and subscribe for more insights and updates. Hit the bell icon so you never miss a video.